Hello everyone and welcome to another feature property video with Nidal Rasheed. Today I'm actually quite excited to bring you this new opportunity and new project that we've just started working with only in the last week. Now the reason I'm excited about this is because this is one that's close to home and literally close to home. So we are looking at a project in Marden, and for those of you who know, our office is in Marden. So our office is near the corner of Portrush Road and Paynham Road, and this is literally around the corner from us. Now, the reason why I like Marden is because fundamentally it ticks all the boxes for us. You know, we're within 5 k's of the city. So there's Adelaide CBD here, and there's Marden right there. It's actually 4 k's out. It's close to all the amenities that our investors are looking for. So in this example here, we're talking about this project being on number 70 Marden Road, which is right behind the Marden Shopping Centre. So in this shopping centre, you've got your Woolworths, you've got the coffee shops, the fruit and veg shops, you've got all the, like a hairdressers and beauty salons. Importantly, there's a Dan Murphy's in there as well. So, don't have to walk far for your Friday drinks. And even better, it's right next door to a KFC as well. So for those who like their food and their chicken, they don't have to go very far for that. But in all seriousness, fundamentally we look for things like the amenities. So how close it is to shops, schools, transport, hospitals, CBD, etc. So in terms of shops, it's literally right across from the project itself. So this here used to be a car park. It's actually been converted into 17 townhouses. You can literally cross the road, and this door here actually leads into the shopping centre, so it works out really well. If you come around the corner, you've got bus stops which take you through to the city, and there's multiple buses that run around this way. If you sort of walk around the other corner, it takes you through to Marden Senior College. It's walking distance to schools. It's walking distance to a gym right across the other corner. So look, fundamentally this area ticks all the boxes for us in terms of location. Now, what's even better is that the price point that we're going into the market with is also very attractive. So we're looking at $424,000 as a starting price point for these townhouses. And this is for the 2-bedroom townhouses. We've got the 3 bedrooms at $560,000. So I'll just show you quickly what the 2 bedrooms look like so you get an idea. Now the 2 bedrooms are over 2 levels. So you've got the 2-bedroom ones are all the ones facing Marden Road, which is the front ones. And these ones have access from the front or the back. So you've got the entrance from the front, which has, you turn right and you're in bedroom 2. There's a shared bathroom, which has a toilet, shower, basin. The stairs that take you up there to level 2. And then you've got the garage under the main roof with a laundry at the back and under the stair storage. So there's a little doorway at the back. And there's also room for another car. So there is a driveway, which then accommodates for a second car. Now, when you go upstairs, you land into a kitchen, dining, and living area, which is all as one big open plan. You've got a generous sized balcony, and on the other side, you've got bedroom 1, which has an ensuite and built-in robe. So all in all, you're looking at about 120 square meters of living, 2 bedroom, 2 bathroom, single garage with another car space, and that's going to rent for $410 a week. So I'll run you through the numbers and show you what that looks like. The 3-bedroom designs, these are the ones all the ones at the back and to the side. And the way these look, these are actually quite generous in size. So if you have a look here, you've got a double garage this time. So you've got the door which leads in, and you can either access through the garage or through the front. You come through to a living area which is downstairs this time, which has got your kitchen, living, dining. You've got access to the laundry and bathroom downstairs. And again, you've got the stairs going up and understairs storage. And there is an open pergola at the back as well, which also, has room for your clotheslines, rainwater tank, etc. Now, when you go up to the second level, you land into an area which takes you through to all 3 bedrooms. Now, bedroom 1, again, we're talking generous sizes here. They're 3.6 by 3.1 and 3.6 by 3 meter bedrooms. You've got built-in robes and an ensuite for the main bedroom. Bedrooms 2 and 3 have a shared bathroom, and which has a bathtub, shower, toilet, basin. And then, best of all, you got this other room here, which is called a rumpus room. It's a 3 by 3.1 room, which is, big enough to actually turn this into a 4th bedroom. So you can always close this off and have a 4-bedroom home with the 2 bathrooms. And it's also got the balcony, which is, also generous in size. So you got 2 outdoor living areas in this case. This particular property has got 172 square meters of living space. So again, very, very generous in size. So this is just a bit of a rundown on the property. Now, the good thing about these as well is they're actually about 4 to 6 weeks away from completion. So they're well past the lockup stage. They're already looking at booking in practical completion inspections with the people who've already bought in there. My understanding is that there's a handful of them that are available, and we can obviously work on those for our clients. So Rivergum, who's the builder there, they are helping the developers project manage it. We've got a relationship with Rivergum, and they've given us the ability to promote this to our clients. Now, as always, whenever we look at any kind of property, we always run the numbers, because when you're making any kind of investment decision, it's always best to consult a professional. But in our case, we obviously consult in this area specifically. So with this example, I've used the 2-bedroom ones just to give you the entry point, and I've used $425,000 as the purchase price. In terms of our due diligence costs, I've allowed $350. For our settlement costs, now this can vary from person to person, but in this example, I've used 10% deposit. You can put 20%. You can do this with a 5% if you're a first home buyer or an owner occupier, but I've just used the median of 10%, which is $42,500 as a deposit. Stamp duty is calculated on the end value because it's not a house and land package, so you're not settling on the land and constructing, you're buying a completed product. And I've allowed $1,000 for legal fees, although they average anywhere between $500 to $800 on conveyancing, depending on who you go with. In terms of the loan costs, again, I've allowed $400 for a loan package fee. That can be zero depending on which lender you go with. And I've also allowed I've just taken an estimate of the lender's mortgage insurance because we're putting less than 20% deposit. So if you're putting 20% deposit, this figure here is not applicable, but I've put it in for the sake of this example. Now, in terms of improvement costs, there is nil because we are not doing any renovations or extensions or anything like that, so we can keep that blank. However, for our selling costs, I always look at our exit strategy. And in this case, I've allowed 2.2% for an agent's commission, and we're allowing $3,000 for advertising in the event that we have to sell this property, because we've got to work out what our end result is if we do sell. Now, from an income and expense point of view, we've got the rental appraisals coming at $410 per week. That's for the 2-bedroom design. And what I've done is I've also allowed 2 weeks vacancy in there as well. So 2 weeks of the year, there's going to be no tenant, and there's going to be a bit of downtime, which gives us about $20,500 worth of rental income per year. Now, for rates, we're working on $900 a year because it's based on land value and it's going to be minimal land value. We're working on $900. The building and landlord insurance for this property value is going to work out to be roughly about $60 per month. So I've allowed $800 per year. That's for building and landlord. However, part of the body corporate in there, because it's a community title, there's going to be a shared element of the property, meaning there's going to be a shared driveway, there's some shared services, there's a shared bin collection, which means there's a bit of a fund that you have to put money into, and that goes into looking after the upkeep of the property. In this case, we're looking at $150 a quarter, which is $600 a year, and part of that also covers parts of the building insurance. So, I've doubled up a little bit, but that's okay. Now, we don't have any repairs or maintenance or cleaning or service contract as such. There's no garden and lawn maintenance costs. Letting fee, I've allowed 1 week's rent every year for reletting the property. And I've also allowed 8% for property management as well. Probably the only other fee that's not in here is going to be water supply. And as a landlord, you pay for the supply, tenant pays for the usage. So I've allowed $440 a year there. Now, in terms of the loan structure, I'm going to run through the raw costs of this. So I'm going to keep this as interest only. I'm doing a 30-year loan term, and we're borrowing $382,500, which is 90% of the value. The loan interest rate can vary from person to person and on the type of loan that you apply for. So what I mean by that, you can get loans for investments in the low 3%. But that means you're putting a 20% deposit, you're paying principal and interest, and it's a low risk deal for the lender. If you're borrowing higher than that, then you're looking at probably the high 3s. Either way, I've allowed up to 4%, meaning that we've left a bit of a buffer there, and just to be on the safer side, so to speak. Next part is the tax and market factors. So, as you know, with brand new properties, you get depreciation benefits. In this case, these are brand new, so they're also high-end builds. So we're talking stone bench tops, high ceilings, LED downlights. The builders and the developers actually have gone for a high-end product. They haven't spared any costs in trying to make these cheap or anything like that. But because of obviously less land value, you're going to get a cheaper price point. However, you got a significant amount of depreciation you can claim. So we're talking about 12 grand in the first year, 11 in the second, 10 and a half, 10, and it drops down incrementally. And this is done on a sliding scale depreciation schedule. So you're getting the bulk of the benefits up front, and then over time it bottoms out at around 2.5% of the build value over 40 years. Now the next section over is your CPI and capital growth. As we know, cost of living goes up every year, so we allow that into our expenses. So every year our expenses and costs are going up by 3%. Our capital growth rate is usually CPI plus 1 or 2% depending on the area. That's what we forecast, particularly if we're working in high growth and blue chip areas, which Marden is. You'd probably expect a little bit more than that, but I'm banking on about 5% growth. Over a 10-year period, that doesn't quite double, but at least we're getting some consistent and good growth. And for those of you who know Marden, it's actually performed well above 5%. And then the last section is the taxable income. So depending on how much you earn, that's what figure we plug in here. But I've put $85,000 because that's the average of people that we work with usually. Some people are starting out with 40, 50 grand. Some people are earning high six figures. I find that just by using the median gives us a good indication anyway. So this is what our forecast or our analysis looks like. So if you bought this property at $425,000 over a 10-year period with a 5% growth, we expect that this property will be worth $692,000. So that's approximately $270,000 worth of growth that you're going to get over a 10-year period. So it doesn't quite double, but $270,000 over 10 years, if you average it out, that's $27,000 a year that you're adding to your bottom line in capital growth. Now, if you worked out $27,000 per year, divide that by how many weeks of the year, that means every week you're making $520 per week in capital growth without you do not have to work any extra hours for. And we've spoken about making a shift from selling your time for money as opposed to making money work for you. This is what we're talking about. All right, this is only one of the 3 ways that we're going to make money out of this deal. So number one way is through capital growth. Now the loan and equity side of it, I'm going to just adjust this. So as you know from this example, we've done this as interest only, which means the loan amount doesn't actually go down in this example. However, as the value of the property increases, the loan to value ratio decreases. So, let's take an example. By year 2023, this property is worth $516. The loan on it is still $382. We've got $134,000 worth of equity now in this property. The bank still wants to keep their 10% that ratio that we've started with, which means now we've got access to $82,432 worth of equity that we can redraw at that 90%. Now at that point you might say, no, I want to reduce my LVR down to 80%, which means you can keep $134,000 worth of equity in the property and then only draw out $30,000. So look, what you do with that, that's obviously determined at a later date, but that's just for the sake of the example. When we look at the rental income, based on the $410 a week and 2 weeks vacancy, we're expecting $20,500 in rent for the year, which translates to a 4.8% gross yield, and then filters down to a 3.7% net yield. When we look at the expenses, again, basing it on 4% interest rate, that means there's $15,300 in interest payments, and we've got $4,790 in property expenses. So what that means is this property is now costing us $20,090 per year. So we've got $20,090 going out, we've got $20,500 coming in. So that means pre-tax, this property is making us $8 per week, or $410 a year. So obviously you're not going to be able to retire off $8 a week. However, that's not what we're banking on. What happens with brand new properties is that we got the depreciation benefits. So because we've got depreciation, we get to claim that every year. Because we've had some upfront costs as well, particularly around the loan establishment costs, the lender's mortgage insurance, and any fees that you incur to set this property up is also tax deductible. So it's obviously averaged out, which means in the first year, we've got $12,932 worth of deductions that we can claim. If we take that off our taxable income, or the person who's earning 85 grand, they're going to get back $4,428 from the ATO. So that $4,428 plus the $410 now means this property is positively cash flowed by $4,838, which works out to $93 a week. Now again, you're probably not going to retire off $93 a week, but if this was one of the properties in your portfolio, making you $5 grand a year in cash flow and making you $27,000 a year in capital growth, then without you having to work any more hours, sell any more product, make any more commission, put in any extra effort, that's a great way to start leveraging yourself and being able to make more with less. And as we've spoken about before in previous videos, the whole idea is making that shift from working harder and working longer to make more money, as opposed to making the shift and making your money work for you. So if you were to treat each dollar as an employee, and you think about how much this has actually cost you to get into, initially we had $42,500 as a deposit, and $28,000 were our purchasing costs. This is the lender's mortgage insurances, the establishment costs, the whole lot. So far we're into it for $42,500 plus $28,903. So we've spent $71,403 to get into this deal, right? Based on this example. However, if all of a sudden we're making just let's call it $5 grand, in cash flow, and we're also making 27,000 in uplift, so that's 32,000. Basically, you're almost getting a 50% return in the first year, just on the cash that you've put in. However, if you were to work out just on the cash, we're looking at a 7% return on your money straight away. That's just based off the 5%. I know this might be confusing for some, so I will stop right there and advise you that if you want to go through the numbers in more detail, please reach out to me, because I'm more than happy to give you different variations of the scenario. One thing I would advise is anyone who's looking at doing any kind of investing is always seek out the advice of a professional. If it's not us, we're happy for you to put you in touch with others that we know specialize in this space, but it's always advisable to chat with an accountant, an advisor, in some cases financial planners. Brokers are good to give you advice from a loan side of it, but they rely on us as well to be able to give them the property advice. If this stuff is of interest, reach out. More than happy to have a chat, and we can take it from there. So as always, hope you're having a great day. Look forward to reconnecting with you guys soon. All right, all the best and take care.